Hello everyone, welcome to the 55 episode of me learning how to trade in Forex. So in the last video we went through what is support resistance, saw that diagram, resistance levels is surplus of sellers, support levels indicate surplus of buyers, trading the bounce, trading the break, plotting support resistance. Did that, interesting bits about supports and resistance, made some notes on that, and now we're currently doing trend lines. So okay, so that's a bit weird, that's beside the point, but let's just do this and delete. Let's go trend lines. Trend lines are probably the most common form of technical analysis in Forex trading. They are probably one of the most underutilized ones as well. If drawn correctly, they can be as accurate as any other method. Unfortunately, most Forex traders don't draw them correctly or try to make the line fit the market instead of the other way around. Make the line fit the market instead of the other way around. So it should be market fitting the line. Or try to make the line fit the market instead of the other. So it should be market fitting the line. Trend lines should be drawn with the market fitting the line instead of making the line fit the market. So uptrend, you got boom, 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 boom. Uptrend line support, downtrend line resistance, 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 resistance. Downtrend, boom, 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 boom. In the most basic form, an uptrend is a line drawn along the bottom of easily identifiable support areas or valleys. So uptrend line is drawn along the bottom of easily identifiable support areas, or known as valleys. Down and downtrend line is drawn along the top of easily identifiable resistance areas, or known as peaks. Let's just do this, boom, boom. Bang, bang. Bang. Cool. This is known as an ascending trend line. This is ascending trend line because it's going up, and this must be an descending. That is not how it's called. Descending trend line because it's going down. How do you draw trend lines? To draw Forex trend lines properly, all you have to do is locate two major tops or bottoms and connect them. What's next? Nothing. That's it. Is that it? Yes. Yep. It's that simple. Here are our trend lines in action. Look at those waves. So to draw Forex trend lines properly, locate two major tops or bottoms and connect them. Two major tops and bottoms and connect them. So that's a major bottom, that's a major top, that's an uptrend, major top, major bottom, downtrend. I guess that could also be an uptrend as well though. That's definitely an uptrend. Yeah. So it's just hard to know like how much of the graph you should focus on. So for example, in this photo here, in this section here, they've done it as a sideways trend, but if you zoom in on only this bit here, then I guess that could be like a mini uptrend as well. So that's the hard bit, I reckon. So there are three types of trends. Uptrend, also known as higher lows. Downtrend, also known as lower highs. And sideways trend, ranging. Because it's in between two boundaries, I'm assuming. Here are some important things to remember using trend lines in Forex trading. It takes at least two major tops or bottoms to draw a valid trend line, but it takes three to confirm a trend line. At least two tops or bottoms to draw a valid trend line, but takes three to confirm a trend line. So 1, 2, and then where's the third one? 1, 2, 3. So that's a trend line. 1, 2, 3. That's still going down. Right, okay. The steeper the trend line you draw, the less reliable it is going to be and the more likely it will break. The steeper. So it's like that basically, the steeper. Actually no, steeper means how the gradient of the trend line. So if it's like that, then it's more likely to break than doing like that, right? The trend line you draw, the more likely it is to break. Oh, the less reliable it's going to be, and the more likely it will break. Like horizontal support resistance levels, trend line becomes stronger the more times they're tested. Trend lines become stronger the more they're tested. And most importantly, do not ever draw trend lines by forcing them to fit the market. If they do not fit right, then that trend line isn't a valid one. Don't ever force. Don't ever draw trend lines by forcing them to fit the market. If they do not fit right, that trend line isn't the one. Don't ever draw trend lines or forcing them to fit the market. If they do not fit right, that trend line isn't the one. Isn't the valid one. Here we go, that's fixed it. Trend channels. 402 2024. There we go. If we take this trend line theory one step further and draw a parallel line at the same angle of the uptrend or downtrend, we will have created a channel. Wait, so if we take this trend line theory one step further and draw a parallel line at the same angle of the uptrend or downtrend, so draw a parallel line like here, like that, we'll have created a channel. Oh, or do they mean like up above it, like here? No, we're not talking about ESPN, National Geographic Channel, or Cartoon Network. These channels aren't television channels, they're trend channels, sometimes also called price channels. Trend channels, also called price channels. Still, this doesn't mean that you should walk away like it's a commercial break. Channels can be just as exciting as watch as Stranger Things or Keeping Up with the Kardashians. Trend channels are just another tool in technical analysis that can be used to determine good places to buy or sell. The upper trend line marks resistance and lower trend line marks support, so both the tops and bottoms of the channel represent potential areas of support or resistance. Trend channels with a negative slope going down are considered bearish, and those with a positive slope up are considered bullish. So you place it above it if it's oh no, you place it below it if it's going, no, you place it above it if it's going up, aka bullish, and then you place one below it if it's going down, aka bearish. So do that. So up channel, down channel. What's this bit here though? Up channel, down channel, sideways channel. To create an up ascending channel, simply draw a parallel line at the same angle as an uptrend line and then move that line to a position where it touches the most recent peak. So like here, this should be done at the same time you create the trend line. To create a down descending channel, simply draw a parallel line at the same angle as the downtrend line and then move that line to a position where it touches the most recent valley. This should be done at the same time you create the trend line. When prices hit the lower trend line, this may be used as a buying area, so this bit here, or this bit here. When prices hit the upper trend line, or this bit here, or this bit here, this may be used as a selling area. Because if you buy here, then it will go up like that, but if it hits here, then sell it, so then sell here, and then, right, okay, and then the price drops, right, and then same with this one, so you sell here, price drops, if you buy here, then price raises. Create an ascending channel. Draw a parallel line at the same angle as the uptrend line. Draw a parallel line the same angle at the same angle as an uptrend line, and move that line to a position where it touches the most recent peak. This should be done at the same time you create the trend line. This should be done at the same time you create the trend line. Create a down descending channel to create a descending channel. Should be a descending channel. draw a parallel line at the same angle as a down trend line, and then move that line to a position where it touches the most recent value, right? This should be done at the same time you create the trend line. When prices hit the lower trend line, this may be used as a buying area. When prices hit the upper trend line, this may be used as a selling area. Types of trend channels. There are three types of trend channels: ascending channel, higher highs and higher lows; descending channel, lower highs and lower lows; horizontal channel, ranging. Three types of channels: higher ascending channel, higher highs and higher lows; descending channel, lower highs and lower lows; horizontal channel, ranging. Some traders prefer to use the terms rising channel for an ascending channel and falling channel for a descending channel, most likely millennials. Important things to remember about drawing trend channels. When constructing a trend channel, both trend lines must be parallel to each other. Generally, the bottom of the trend line channel is considered the buy zone, whilst the top of the trend channel is considered the sell zone. Like in drawing trend lines, do not ever force the price to the channels that you draw. Do not ever force a price to the channels that you draw. Force the price to the channels you draw. A channel boundary that is sloping at one angle whilst the corresponding channel boundary is sloping at a different angle is not correct and could lead to bad trades. Right, so must be parallel to each other. A channel boundary that is sloping at one angle whilst the corresponding channel boundary is sloping at a different angle is not correct and could lead to bad trades. When this happens, this chart pattern is no longer a trend channel but a triangle, which you will learn more about later. That said, trend channels don't have to be completely parallel, nor does 100% of the price action have to fit within the channel. A common mistake many traders make is that they only look for textbook price patterns. They miss important information about price action and close their eyes to other important clues. Notice the channel drawings below. Do they look perfect? Waiting for the picture perfect textbook examples won't help you in the real world, because it's going to be pretty rare to see price action that fits perfectly within two perfectly parallel trend lines. It's like trying to find the perfect man or woman in the real world. Once you find that person, don't let go. Don't have to be completely parallel, nor does 100% of the price action have to fit within the channel. Perfect textbook examples of patterns won't exist in real world. Not won't, are very rare. That's better. Right, next lesson. How to trade support resistance. (24/02/2024). Now that you know the basics of how to trade support and resistance, it's time to apply these basic but extremely useful technical tools in your trading. Because here at babypips.com we want to make things easy to understand, we have divided how to trade support resistance levels into two simple ideas: the bounce and the break. The bounce. As its name suggests, one method of trading support resistance levels is right after the bounce. Many retail forex traders make the error of setting their orders directly on support resistance levels and then just waiting for their trade to materialize. Sure, this may work at times, but this kind of trading method assumes that a support resistance level will hold without price actually getting there yet. Sure, this may work at times, but this kind of trading method assumes that a support or resistance level will hold without price actually getting there yet. You might be thinking, why don't I just set an entry order right on the line? That way I am assured the best possible price. When playing the bounce, we want to tilt the odds in our favour and find some sort of confirmation that support resistance will hold. When trading the bounce, find some sort of confirmation that the support or resistance will hold. For example, instead of simply just buying right off the bat, we want to wait for it to bounce off support before entering. So you need that confirmation basically that it's actually bouncing basically. If you've been looking to go short, you want to wait for the bounce. You want to wait for it to bounce off resistance before entering. So this is going long. This is going short. You can see a stop loss as well right here in case it actually goes whoop instead of bouncing back, and a stop loss here in case it goes whoop instead of bouncing up. Right, by doing this you avoid these moments where price moves fast and breaks through support resistance levels. From experience, catching a falling knife in trading can get really bloody. The break. In the perfect world, support resistance levels would hold forever. Politicians would never lie, McDonald's would be healthy, and we'd all have jetpacks. In a perfect forex trading world, we could just jump in and out whenever price hits those major support resistance levels and earn loads of money. The fact of the matter is that these levels break often, so it's not enough to just play bounces. You should also know what to do whenever support resistance levels give way. There are two ways to play breaks in trading: the aggressive way or the conservative way. The aggressive way. Hey look, it's Chuck Norris, I think. Two ways to play breaks: aggressive and conservative. The simplest way to play breakouts. Let's rename this to breakouts. The simplest way to play breakouts is to buy or sell whenever price passes convincingly through a support or resistance zone. This is the aggressive, isn't it? Whenever price passes convincingly convincingly through a support or resistance zone. The key word here is convincing, because we only want to enter when the price passes through a significant support or resistance level with ease. We want the support or resistance area to act as if it was just received a Chuck Norris karate chop. We want it to wilt over in pain as price breaks right through it. Stop loss order, so support, this is a breakthrough. We want to enter right here. The conservative way. Imagine this hypothetical situation. You decide to go long EURUSD hoping it would rise after bouncing from a support level. Soon after, the support breaks and now you're holding onto a losing position, with your account balance slowly falling. Do you accept defeat and get the heck out and liquidate your position, or hold on to your trade and hope the price rises up again? If your choice is the second one, then you will easily understand this type of trading method. Remember, whenever you close out your position, you take the opposite side of the trade. Closing your EURUSD long trade at or near break even means you have to short the EURUSD by the same amount. Now, if enough selling and liquidation of losing positions happen at the broken support level, the price will reverse and start falling again. This phenomenon is the main reason why a broken support level becomes a resistance level whenever it breaks. As you would have guessed, taking advantage of this phenomenon is all about being patient. Now, if enough selling and liquidation of losing positions happen at the broken support level, the price will reverse. And start falling again. Wait, so you're going long on a EURUSD and you started buying just after you go long, hoping it would rise after bouncing from a support level. Suddenly after the support breaks, so it breaks past the support level, you hold on to the trades, and then so if others are selling and liquidating their positions, the price will reverse and start falling again, so it will keep falling. This phenomenon is the main reason why a broken support level becomes a resistance level whenever it breaks. As you would have guessed, taking advantage of this phenomenon is all about being patient. Instead of entering right on the break, wait for the price to make a pullback to the broken support or resistance level and enter after the price bounces. Well, I need to reread this again. So the price action comes from here, like breaks through the support line, it rises back up again, back to the support line. So this is where it becomes a resistance line, because it bounces back down again. And then your entry right here. So in the aggressive way, you would have just entered right about here, but this one you'd wait until it goes back to the support line, which becomes a new resistance line, and then buy it at that point there. Right, okay. I think I get what it's trying to say. So to simplify that, instead of entering right on the break, wait for the price to make a pullback to the broken support level, and enter after the price bounces. So broken support level could become a new resistance level. A few words of caution. In Forex, this does not happen all the time. Retests of broken support resistance levels do not happen all the time. There will be times that price will just move in one direction, leave you behind. Because of this, always use stop loss orders and never hold onto a trade just because of hope. Whoops, sorry about that folks, the caps lock key got stuck. Retest, there will be times that price will just move in one direction and leave you behind. Always use stop loss orders and never ever hold onto a trade just because of hope. Stop loss orders and never hold onto a trade just because of hope. Psychological levels. Psychological levels. Year 2024. In technical analysis, a psychological level is a price level that is perceived as significant by traders, often due to its round number or because it has previously acted as a support or resistance level. So psychological level is a price level that is perceived as significant by traders. Often due to its round number or because it has previously acted as a support resistance level. Often due to its round number or because it has previously acted as a support or resistance level. These levels are not based on any inherent fundamental value, but rather on the collective perception and behavior of market participants. Not based on inherent fundamental value, but just the collective perception of and behavior of market participants. These levels, often referred to as invisible lines, often influence both individual and institutional traders' actions, leading to predictable patterns in price movements. What are psychological levels? Psychological levels are price points in financial markets that hold significant meaning for traders and investors, mainly due to their simplicity and ease of remembrance. Typically, these levels are round numbers ending in 00 or halfway points like 50. Typical values are in round numbers, so ending in 00 and halfway points like 50. With currency pairs, the exchange rate of 1.00 or parity is also a big deal. Of 1.00 or parity is a big deal. Traders tend to anchor their decisions around these levels, leading to increased buying and selling pressure when prices approach or surpass them. A nice way to think about psychological levels is that traders become psychos when prices near them. For example, if USD/JPY is approaching a round number like 100, traders may be more likely to buy or sell that level, as they may feel that represents an important milestone. Similarly, if USD/JPY has previously bounced off a certain price level, traders may see that level as a key support or resistance level, and may adjust their trade accordingly. Why do psychological levels matter? Psychological levels are important in technical analysis because they can influence the behavior of traders. The human brain is naturally inclined to seek simplicity and order. In trading, this tendency results in a preference for the round numbers and other easily recognizable patterns. As more market participants focus on these levels, they can become self-fulfilling prophecies, with prices reacting predictably as they reach, hit, or break through psychological barriers. For example, a significant psychological level like 1,000 in the Euro USD currency, or like 1.0000 in the Euro USD currency pair, may attract a substantial amount of attention from traders. So this bit here. As the price nears this level, some traders may place buy orders in anticipation of a bounce, whilst others may place sell orders expecting a reversal. This increased activity can result in price fluctuations around the psychological level, leading to trading opportunities for yourself. What are examples of psychological levels? Here are some examples of psychological levels. Examples of psychological events or levels, not events. Round numbers. These are price levels that end in 0 or 5, such as 100 or 1.5. These levels are often seen as psychologically significant as they represent round numbers and are easy to remember. So previous highs or lows. If an asset has previously reached a certain high or low price, traders may see that level as a key support or resistance level, and may expect the price to bounce off that level again in the future. These could be daily, weekly, yearly, or all-time highs or lows. Traders may see the certain high or low as key supports or resistance levels. Moving averages. Moving averages, which will be discussed later in the School of Pipsology, are commonly used in technical analysis to identify trends and potential support or resistance levels. Traders may see a moving average as a psychological level if it has previously acted as a support or resistance level. How to trade psychological levels. Identify key levels. Psychological levels. Identify key levels. So that means identify. The first step in incorporating psychological levels into your trading is to identify the key levels relevant to the financial instrument, e.g. currency pair you're trading. Identify the key levels relevant to the currency pair being traded. This can be done by observing historical price action. Done by observing historical price action and noting round numbers where the price has previously shown significant reactions. Significantly reactions. It has previously monitor price action. Keep a close eye on how the price behaves as it approaches the psychological level. Look for signs of increased price volatility, as this can indicate heightened interest from market participants. The price behaves as it approaches a psychological level. Look for signs of increased price volatility, as this can indicate heightened interests from market participants. Set entry and exit points. Once you have identified a psychological level and observed price action around it, use this information to set entry and exit points for your trade. For example, if the price has bounced off a psychological support level, you might enter a long position just above the level and set a stop loss slightly below it. Okay, I think that needs explaining. Summary. In summary, a psychological level in technical analysis is a price level that is perceived as significant by traders and investors, often due to its round number or because it has previously acted as a support or resistance level. These levels gain significance simply due to the attention traders pay to them. Traders will often react and make trading decisions around these levels, even though there may not be any logical importance to that of that specific number. Traders often set their orders around these levels, so when a price approaches these levels, it can trigger a cluster of buy or sell orders that cause a price to stall or reverse. Breaking through a psychological level can signal further move in that direction, as it suggests traders' attitudes or psychology around that stock or market are changing. Breaking through a psychological level can signal a further move in that direction, as it suggests traders' attitude or psychology is changing, right? Is changing. For example, Euro USD breaking through 1.008 to the upside could signal bullish momentum. Markets will often test these levels to see if they still hold before continuing a trend. For example, a market may rally up to but not quite reach a round number before pulling back again, then make another run at that level. Cool. Summary, trading support and resistance. I'm going to leave this episode here. Thank you very much for watching. In the next video, we'll just summarize trading support and resistance. So, yeah, I will see you guys then. Peace.